Welcome to TruePath Finance Australia. Today we're exploring one of the biggest financial goals for many Australians, paying off the home loan faster. For many people, a mortgage can last 25 to 30 years, but there are strategies that may help reduce interest costs and potentially cut years off the loan. But not every strategy works for everyone. Some approaches increase flexibility, some improve cash flow, some increase risk, and some could actually leave people worse off if they're not careful. So in this video, we'll explore many of the common ways Australians try to pay off their mortgage faster, along with the positives and negatives of each approach. Before we begin, this video is for general information only and does not constitute personal financial advice. It does not take into account your objectives, financial situation, or needs. You should consider seeking independent professional advice before making any financial decisions. One reason many Australians focus on paying down their mortgage faster is the amount of interest paid over time. A large loan over 30 years can result in hundreds of thousands of dollars in interest. By reducing the loan faster, people may save money on interest, own their home sooner, and improve long-term financial flexibility. But it's also important to balance mortgage repayments with emergency savings, superannuation, investing, and lifestyle goals. Paying off the mortgage aggressively isn't always the best option for every person or family. One of the simplest ways to potentially reduce a mortgage faster is making extra repayments. Even small additional amounts can make a significant difference over time because they reduce the loan principal earlier. For example, an extra $50, $100, or $200 per week may potentially save years off a loan. The positives are simplicity and lower interest costs. But the downside is that money placed directly into the loan may not always be easily accessible again. And for fixed-rate loans, lenders may place limits on how much extra can be repaid each year. Another popular strategy is switching from monthly repayments to fortnightly repayments. Because there are 26 fortnights in a year, this effectively results in an extra month of repayments annually. For some borrowers, this can help reduce the loan balance faster while fitting naturally with their salary cycle. The positive is that it may accelerate repayments without feeling like a major lifestyle change. But borrowers still need to ensure they maintain enough cash flow for other expenses and emergencies. Offset accounts are one of the most popular mortgage strategies in Australia. An offset account links savings to the mortgage balance. For example, if someone has a $700,000 mortgage and $50,000 in the offset, interest may only be charged on $650,000. This can potentially reduce interest costs while still keeping money accessible. Many people like offset accounts because they combine flexibility with debt reduction. But they only work well if borrowers consistently keep money in the account rather than spending it. A redraw facility allows borrowers to make extra repayments and potentially withdraw those extra funds later if needed. This can create flexibility while still reducing interest costs. However, redraw facilities are controlled by lenders. Rules can vary, access may change, and withdrawing money can increase debt again. For some people, redraw can be useful. For others, it may encourage spending money that was originally used to reduce debt. Refinancing means replacing the current loan with a new one, often to secure a lower interest rate or improved features. Even a small reduction in interest rates can potentially save thousands over time. But refinancing also has risks. Some borrowers refinance and reset the loan back to 30 years, which can actually increase total interest paid if they reduce repayments. There may also be fees, discharge costs, and lending criteria to consider. This is why comparing both the interest rate and the overall loan strategy is important. One strategy many financially disciplined Australians use is directing additional income straight toward the mortgage. This may include bonuses, tax refunds, overtime, or side hustle income. The idea is to avoid lifestyle inflation, where income increases but spending increases just as fast. The benefit is potentially reducing debt significantly faster, but the trade-off may be reduced lifestyle flexibility or slower investing elsewhere. Debt recycling is a more advanced strategy often discussed by financially experienced Australians. The general idea is to gradually convert non-deductible home loan debt into investment debt. This may allow borrowers to invest, potentially improve tax efficiency, and grow wealth over time. But debt recycling involves investment risk, taxation considerations, and loan structuring. If investments fall in value or cash flow becomes difficult, risks increase. This is usually a strategy where people should seek professional financial and tax advice before proceeding. Some Australians choose not to aggressively pay off the mortgage. Instead, they may invest extra money into shares, ETFs, superannuation, or investment property. The logic is that investment returns may potentially exceed mortgage interest rates over the long term. But unlike paying down debt, investing involves risk. Markets can fall, returns are not guaranteed, and emotional stress can increase during downturns. For some people, the peace of mind of reducing debt is more valuable. For others, investing may align better with long-term wealth goals. Another important consideration is whether the loan is fixed, variable, or split. Fixed loans may provide repayment certainty, but often limit flexibility. Variable loans may allow offset accounts, extra repayments, and redraw facilities. Some Australians choose split loans, where part of the mortgage is fixed and part remains variable. This can create balance between certainty and flexibility, but it also adds complexity. Australians use a strategy called rent vesting. This involves renting where they want to live, while buying investment property in more affordable areas. The idea is to enter the property market sooner while maintaining lifestyle flexibility. But investment properties come with risks, vacancies, maintenance, market changes, and interest rate pressures. And emotionally, some people simply prefer owning the home they live in. While paying down debt can be positive, there are also common mistakes. Some people focus so heavily on the mortgage that they neglect emergency savings, investing, or retirement planning. Others overcommit repayments and create financial stress. And some refinance repeatedly or take on complex strategies without fully understanding the risks. A balanced approach is often important. There is no single perfect strategy for every Australian. The best approach often depends on personal goals, risk tolerance, cash flow, and overall financial situation. Some people value certainty and debt reduction. Others focus on investing and long-term wealth growth. And many use a combination of strategies. Paying off a home loan faster can potentially reduce stress, lower interest costs, and improve long-term financial freedom. But every strategy has positives and negatives. The key is understanding how each strategy works, what risks exist, and whether it aligns with personal goals. Sometimes the best strategy isn't the fastest strategy, it's the one that is sustainable long-term. This content is provided for general information only and does not constitute personal financial advice. TruePath Finance Australia exists to help Australians understand how the financial system works, in plain English. If you found this helpful, consider subscribing for more general education like this.